boning up on some knowledge for some complex transactions.
What type of transactions are so complex in our market?
Oh, nothing's really all that complex when you get right down to it. It's nothing that years and years of experience can't solve.
And a little misery and suffering.
It's true. So, I think we should talk about foreclosures.
Ah, that special beast that is the bank-owned property.
You know, honestly, I really love foreclosures. Like, more than half of what I've done this year is foreclosures. And I've learned to love them.
It's good for the buyers.
Yeah, it's just, the only thing is especially if you bought a house before, understanding that the process of buying a foreclosure is going to be a little different.
And can be a little
Than
bit
buying
frustrating.
a normal house.
Yeah.
It's frustrating if you don't know what to expect.
Right.
Personally, I have come to sort of love the institutional aspect. Like,
the sterility?
Yeah, nobody's getting their nose out of joint when you ask for something or when you offer a little low. They just counter it. There's no dramas.
But buyers can get a little bit excited unless they know what to expect. And that's what we're hoping to shed a bit of light on, right?
Yes.
About the process.
So I'm just going to do a quick breakdown on like how a foreclosure happens, just so we can talk about kind of, there's some misconceptions about what buying a foreclosure is.
Or what is it an REO? Is
it
a foreclosure? Is it a bank-owned?
Is it the courthouse steps? Like, let's talk about that.
Okay.
So if a person doesn't make their house payment, their mortgage will go delinquent. They're going to get all those notices on the door that all the news stations like to take videos of when they talk about how horrible everything is. And then they'll have a foreclosure date. And on that date, that's when the whole auction at the courthouse steps thing happens. And while there are some people out there that have a business of buying houses in that situation, we are not going to talk about that today because it's incredibly complex, legally fraught, and you have to pay cash. Actually, you pay with cashier's checks in the exact amount. So people go down there with like $10,000 cashier checks.
Your typical home buyer is not going to buy an auction at the courthouse steps.
Nor would they want to because, they probably won't have all of the resources to deal with the title issues, the liens, all of that stuff. You want to leave that to the professionals or get like really lawyered up.
Okay.
So let's talk about what happens after that auction. Because a lot of times it doesn't sell at auction. Some investor doesn't swoop in and buy it there. So what does the bank do then?
Well, in many cases, they buy it back essentially.
Mm-hmm.
And so then one of the things we're seeing is the period of time between the auction and when it gets relisted on the market, which is when we can sell the property to you.
It varies.
But it's shorter.
It is shorter.
Like they're starting to turn them around more quickly.
It's true.
So we do have some resources where we can see that a property is scheduled for auction because that's all recorded in public record.
Mm-hmm.
So it comes up, it goes, and then eventually it comes back on to the MLS.
So the bank is going to actually list it with a real estate agent, and it will go on the MLS. So it'll be on all the websites on the internet just like normal as a bank-owned house.
Right.
So it's not like you have to do anything special to find them. A lot of agents
don't fall for that business where you sign up for something online.
We're going to get you foreclosures, kids.
Not necessary.
Everybody has the foreclosures. You have the foreclosures. Anne's got the foreclosures. I got the foreclosures.
Learn how to search the public records.
Also
you don't get all the private info. But it's going to go on the market just like any other listing, but it's not just like any other listing.
No, and in some ways it's better, and in some ways it's a pain. So let's just walk through that.
Okay.
Let's walk down that road.
So we go to show property. What are some of the things we need to know? We're going to look at the showing instructions, which are going to probably have a whole paragraph of agent-only remarks about things like maybe this property is protected by the First Look initiative.
I love stuff like that, because most of my clients are not investors. I have one poor investor right now that this has actually kind of been a pain about. But most of my clients are actually going to live in the house that they're buying, which is awesome because these bank properties, the banks aren't fooling around. They generally price them pretty aggressively. And if they put it out there and it's not selling, they drop it until it sells, which is kind of a pain for people that have a bank-owned house for sale in their neighborhood. They're thinking like, oh my gosh, that's what my house is worth. No, bank houses tend to sell for a little less. You don't think they do?
Well, I was just going to say they do, but more recently, bank-owned properties have started to really come up level with the rest of the market because of the
they're
demand.
selling. Yes.
For a while, they were markedly below the actual value in the neighborhood, and now they're either, in some cases, putting a little money into them to get them fixed up and financeable.
That's true.
Because then they can get more offers. Or in some cases, I've seen them where they sit for a month, and then they start just hacking away at that price.
And so what's cool is when a bank home does come on the market and it has a good price and it's dialed in and it's ready to go, investors can't swoop in and get the bank to give it to you for cash, because they actually have a window of 10 days, 16 days that's only for owner occupants.
And this is primarily with Freddie Mac and Fannie Mae.
Right.
That they've got, and there's a couple other programs, but those are the two big ones.
HUD.
HUD, where you've got a program of 10 days to 2 weeks, somewhere in there, where it's protected for owner occupants only. So great advantage for some buyers.
And if you're an investor and you want to buy a bank-owned house that has one of those on it, you just have to wait it out.
Yeah.
And, you know.
And it may become available. So you go in, what's one of the other differences? There's sometimes the first look.
Sometimes the lights are off and the toilet doesn't work, so don't pee in the toilet.
Make sure you go before you
don't be that
properties.
Person.
Yeah, don't ruin it for the rest of us. So many times the utilities were shut down as part of the foreclosure. The property's been winterized, even though it's summer right now. They winterize the property to protect against leaks and things like that. And it can take a long time for the utilities to get turned back on. So these agents that manage these properties, these bank-owned properties, they usually are in charge of getting the utilities switched over. So you may write an offer on one of these properties, and the utilities may not be on yet. What does that mean for your inspection?
It just means that you might not be able to book your inspection as soon as that contract's signed around. And if that's the case, I mean, I've had the situation where we're 8 days in and there's some old bill that they have to get paid off that they haven't been able to clear, and we're only now just getting the utilities on. I have never had a situation where a bank wasn't willing to extend because it was their fault. I mean, in that way, in my experience, the banks have always been pretty honorable.
We've reached a new normal where, you just
they
go ahead and
know
extend that inspection period if utilities are not available. Because for not only your inspection, but also for your appraisal, you need to have...
Appraisers require the lights on and the
water running to the faucets and the toilets and all those things. So even though the contract, and that's probably the most major difference between bank-owned properties and typical sales, is that they're using their contracts, sometimes over top of our state contracts, sometimes in addition to, but because these banks are doing business maybe in all 50 states, they can't go by our contract. The biggest thing that you should know is going in, the contract is going to say you're buying it as is, you're going to make some compromises that you wouldn't typically make in a normal sale, and the assumption is that you're going to do this in exchange for a good price and the ability to purchase this property. And typically, they're going to let you out of the agreement, if you don't like, say you do your inspection and you're unhappy, if the title has an issue with it, they're not trying to keep your earnest money. They just want to sell the property.
No, but it's just important to take an extra look at those pages, because we're not trained on them.
Right.
And we do our best to read them. But I've had clients get lawyers look them over. And
that is always
explain
advisable.
It's something that you should do, because we
get attorneys.
No, and not only that, like I've sold, half the houses I've sold this year have been bank forms. I'm not sure I've seen the same one twice yet. Right. Even when it's the same bank, they've got a new version, they've got a new rule. Before they were paying for resale certificates, now they're not paying for resale certificates on condos. Like, things change. People find confusing about buying a bank-owned house is that phrase, as is. They're like,
which is plastered in bold print throughout the contract.
It's liability, whatever. So, in the state of Washington, nothing's ever really as is.
There's no technical designation for that.
Yeah, so if you need something done, you can always ask for it. But it's just important to know that with a bank, they're not gonna fix your light switch covers. They're not gonna do anything unless it's a danger to you. Unless they,
Yeah, I had one recently. They're not even, the toilet doesn't flush. Okay, that's your problem. They are not concerned with those items. No. And sometimes that, buyers' feelings get hurt a little bit because
this house isn't ready.
Right, and that's something you need to know when you go in. So you get through your inspection, you get through your appraisal, and you're heading down to closing. One of the other major differences is the closing time frame that's involved, because it's not just a seller who comes across to escrow and signs the hour after you do the closing.
No, they gotta send it off to the bank to review.
So you gotta build in a little bit of extra time, and they are not very flexible about the closing date. So we're seeing, because of how much activity there is in the market, lenders are backed up, escrow companies are backed up. Your foreclosure, the bank that owns the foreclosure, they may charge you by the day. They have per diem.
$100 a day, $50. I've seen $250 a day
for going over your closing date.
Close on time.
So there's not flexibility in that part of the process either.
Not usually.
Yeah. And that varies. That varies widely with the institution that owns the property. They each have different policies, but generally speaking, there's not as much latitude to adjust some of those details of the contract. So keep that in mind.
Another thing that's different from a normal sale about closing is that there can be fees. And I've been doing a lot of Fannie Mae, Freddie Mac lately, and they're just wonderful, and they don't charge for a bunch of stupid crap like that. But a lot of the banks do charge you a $250 rekeying fee to put like a crappy $5 lock on your front door that you're going to have to rekey anyway. But whatever, for liability reasons, they rekey the house and then they charge you for it.
And it's kind of snuck into the contract. That's what we're saying. It's not a normal part of the contract. It's added on there somewhere. But
all of a sudden, at the last minute, they're like, "Where's our $250?" And you're like,
tacked onto your closing costs.
Thanks.
So there's a few of those things that will be different, but in most cases, it's well worth it.
Pretty straightforward. And, one other thing to mention, something like Fannie Mae or Freddie Mac, these are actually government owned. I mean, they feel like bank owned, but it's not government, I guess. Does the government still own Fannie Mae and Freddie Mac? It's such a weird Frankensteinian situation. Anyway, so they will actually provide financing. Can I go off on this road a little bit?
Talk home path.
Can I hop on that on the financing train?
It's a pretty attractive option.
So the cool thing is they'll the rate's a little bit higher, but there's no, at least in our current, it's summer of 2013.
Right,
the rate's a little higher, but there's no mortgage insurance.
At
so
3% down.
3% down if you're going to live in it. If you're an investor, 10% down. I mean, it's crazy.
And there's a rehab option within that program also, right?
Yeah, I've never done that.
I haven't either. Generally, 203K.
Word on the street is it's not a 203. It's a home path renovation.
Right.
It's like its own crazy loan.
But it's kind of comparable to a 203K.
So look, we don't know everything, but we do know who to ask. Anyway, so the cool thing about that is they will finance the property for you. There's no appraisal. It's very smooth. It's less expensive. That said, there is one little downside to that, and that is condos. So if you are buying a Fannie Mae or Freddie Mac condo, and they are providing the financing for that condo, it's really important to know and to investigate on your own whether or not anyone else can buy a condo in that building. Because I've had the situation where the condo is not financeable anymore, and so somebody buys in. I mean, not one of my clients,
obviously,
God forbid. But people have bought in on these home path loans, thinking, it's easy to buy a condo in this building, and then they realize, this is it's cash only in this building until the building gets their act together. But because Fannie Mae or Freddie Mac was providing their own financing and it was super easy to get in there, they didn't realize that for most people it's actually kind of hard, and that was a one-time deal. So
when they go to resell it, you're saying when they go to resell it, somebody else might not be able to.
Absolutely, and it also, the larger the variety of financing options available to a property, the more buyers, which means the more money you can get.
And because foreclosures are sometimes listed below market value, look, a plane. There is something to be said. You've got to brace yourself in many cases for multiple offer situations. It's a very regular part of.
But can I say?
Yes.
I love the way banks do multiple offer situations.
It's like everything else. It's very clean and sterile.
Oh, it's so nice because you're like, here's our offer, and they're like, whoa, doggies, there are multiple offers, and everyone goes. And then they say, everybody get me your highest and best offer by tomorrow at 5 or tomorrow at noon. And then you just know, I'm going to give it my best, the best I can do for this property.
Right.
And then we'll see how the cards fall. You don't have agents being like, well, Susie says she can get up to so-and-so, and can you do this, and can you reduce this, and it's just, no, everybody just does their best.
And it doesn't matter if there's one offer in addition to yours or 10 offers. They just play it that way. And so if it's a new property, the reason this often...
And no, you can't know what those other offers are.
No, ask us
that would ruin the fun. That would ruin the fun.
And it's like, you've got to have it by this deadline, not a minute after, or you miss your window. So it's important to know when you're going in and checking a property out that you may be set up for that. Mm-hmm. And you have to kind of brace yourself. So you may not want to go in with your best offer, for instance, out of the gate, because on a lot of these foreclosures, you will be subject to the multiple offer scenario.
Man, I've gotten back and forth one time with one, I had an investor, and she was a friend, and we went back 4 times.
Through the multiples?
Yeah, well, no, there was no multiple. It was like, here we are, and they were like, we're up here, and we were like, it wasn't like with a normal seller where you know.
They're mad at you.
We're like, and they were like, and we worked our way to the middle, and we got there, and it was awesome, and that you can't do that with a...
That's another big difference, though, because once they did accept your offer, one of the things about foreclosures is they might accept your offer verbally on Tuesday. So say you're the winner of the multiple offer situation. You submitted over the weekend. Monday they gave notice of highest and best. Tuesday they said have your best offer in by Tuesday at noon. Tuesday afternoon they pick you. They say you're a buyer, just won the deal. You may not have a signed around contract with everybody's initials on it because they're going to send their paperwork that their people typed up for you to sign as the buyer, and then they will sign it after that. So there's a period of time there where it's just verbal. We don't have a copy of everything in writing for you.
And
it's just the way they do business.
I've never heard of that going
Sideways.
south. I mean, you would never
In
do
a regular deal, you never do that.
I wouldn't. That nothing is verbal in real estate. I mean, we should probably. I mean, the lawyers
Preface
are
that.
watching. I mean, even with a bank, technically,
But this is how it's done.
but it's how it's done, and it's never fallen apart for me.
No, me neither.
Thanks.
So, just a few little nuances. Maybe you think you know how this process works, or you've been through it recently. You have to be prepared for it doesn't fit within those guidelines.
Things
and,
are a little different.
yeah,
a little
and
special.
it does. I mean, there are some things that are standard
Mm-hmm.
for foreclosures,
Yeah.
versus a regular sale. So there are some things that are predictable, like the multiple offer process, but all bets are off in some ways, and they can make their own rules and they have their own contracts. And if you don't like it, your primary remedy is to not buy the property.
Don't do it.
Oh, baby, give me one more chance.